If you've spent any time on social media in the last year, you've seen the tax advice. Someone standing in front of a luxury SUV explaining how you can write off the entire purchase price. Someone claiming you can rent your house to your own business and collect the income tax free. Someone telling you to form your LLC in Delaware to avoid state taxes. These clips get millions of views. They sound convincing, and most of them leave out the parts that matter: the qualification requirements, the documentation standards, and the consequences when the IRS doesn't agree with your interpretation. Today, we're taking 6 of the most common social media tax claims and running them through the actual rules. Not to tell you none of these strategies exist, some of them are based on real provisions in the tax code, but to show you where the viral version diverges from the legal version and what happens when you implement the viral version on your return. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. When a specific strategy gains traction online, when the same claim is showing up across platforms and millions of people are watching it, the IRS notices. Examiners are trained on emerging issues. When a particular deduction or strategy starts appearing on a high volume of returns in ways that don't hold up, it becomes a focus area. My goal today isn't to tell you that every piece of tax advice on social media is wrong. It's to give you the full picture so you can evaluate what you're seeing against the actual rules. Let's start with the one I get asked about the most, the heavy vehicle deduction. The claim is usually some version of buy a vehicle that weighs over 6,000 pounds and you can write off the entire purchase price in the first year using Section 179 or bonus depreciation. Here's what's actually true. Section 179 and bonus depreciation are real provisions. They do allow for accelerated depreciation of qualifying business assets, including certain vehicles over 6,000 pounds gross vehicle weight rating. Here's what's left out: business use percentage. To deduct the full cost, you need to use the vehicle 100% for business. If you also use it for personal driving, the deduction is limited to the business use percentage. You need a mileage log to support the percentage you claim. The deduction reduces your taxable income. It doesn't eliminate your tax bill dollar for dollar. $1,000 deduction does not put $150,000 back in your pocket. Depreciation recapture. If you take the full deduction in year 1 and then sell the vehicle in year 2, you're required to recapture the depreciation. The IRS effectively takes back the tax benefit on the portion you haven't actually used, and the proportionality issue. If your Schedule C shows $50,000 in revenue and you're claiming a $150,000 vehicle deduction, the relationship between the expense and the business activity is going to raise questions. The heavy vehicle deduction is legitimate, but it has requirements that don't fit in a 30-second clip. Next, the Augusta Rule. The claim is that you can rent your personal home to your business for up to 14 days per year and receive that rental income tax-free. Here's the actual provision. Section 280A does allow homeowners to rent their home for up to 14 days per year without reporting the rental income. That's real. Here's where the social media version falls apart. The rental rate has to be reasonable. You can't charge $5,000 a night if comparable space in your area goes for $200. The rental has to be legitimate. There has to be an actual business purpose, a genuine meeting, a planning session, an event. You need a rental agreement, documentation of what took place, and evidence that the space was used exclusively for business during the rental period. The business deducts the rental payment as an expense. If the payment is unreasonable or unsupported, the deduction gets disallowed on the business return. Most people who implement this based on a social media clip don't have the documentation to support it. Without that documentation, the strategy doesn't survive an examination. Now, paying your kids. The claim is that you can hire your children and pay them up to the standard deduction amount, and because their income falls below the filing threshold, they pay no federal income tax. Here's what's actually true. If you operate as a sole proprietor or a qualifying partnership, wages paid to your children under age 18 are exempt from Social Security and Medicare taxes. The child can earn income, and if it's below the standard deductions, they may owe no federal income tax. Here's what's left out. The child has to actually perform work. Real work appropriate for their age that the business actually needs done. The pay has to be reasonable for the work performed. The child should be on an actual payroll with time records, job descriptions, and evidence of work performed. The employment tax exemption applies to sole proprietorships and qualifying partnerships. If your business is an S Corp or C Corp, the exemption doesn't apply. Next, business meals. The claim is usually if you talk about business for 5 minutes at dinner, the entire meal is deductible. Business meals are generally 50% deductible. There was a temporary 100 provision during 2021 and 2022 for restaurant meals, but that's expired. To claim even the 50% deduction, you need to document the date, the amount, the location, who was present, and the specific business person. And the specific business purpose, not discussed business. The specific topic, what was discussed, what was decided. The meal has to have a clear business purpose. A Saturday night dinner with your spouse where you mentioned the client doesn't qualify. When I was examining returns, meals were one of the easiest deductions to disallow because the documentation was almost never there. Document them at the time they occur, not at tax time. The Delaware LLC claim. The advice: don't form your LLC in your home state. Form it in Delaware or Nevada because those states have more favorable business laws or no income tax. This misunderstands nexus. If you live in a state, work in that state, and conduct business in that state, you have a tax obligation there regardless of where your LLC was formed. If you live in California and form an LLC in Delaware, California considers you to be doing business in California. You still owe California taxes. What you've created is additional cost. You're now paying filing fees in 2 states and maintaining a registered agent in Delaware. For most small business owners, forming in your home state is the most straightforward and cost-effective option. The Delaware strategy applies to C corporations raising institutional capital, not to a single member LLC operating from a home office. Finally, the buy, borrow, die wealth strategy. The claim is that you can avoid taxes entirely by borrowing against your assets instead of selling them. By appreciating assets, borrow against them to fund your lifestyle, and because loans aren't taxable income, you never trigger a tax event. This is a real strategy used by ultra-high net worth individuals with large liquid portfolios and very favorable lending terms. At that scale, the math can work. Here's why it doesn't translate to the average business owner. You need substantial assets a lender will accept as collateral. Millions in liquid holdings. Interest costs can exceed tax savings when rates rise. If your asset value drops, margin calls force you to sell at the worst time, triggering the taxes you were trying to defer. And that strategy relies on the stepped-up basis at death, which is current law but has been the subject of legislative proposals to modify or eliminate. For someone running a small business with normal assets and income, the fundamentals of tax planning, proper entity structure, documented decisions, estimated tax payments, retirement contributions are far more relevant and reliable. The common thread across all 6 is the same. The viral version strips away the requirements. Real tax planning isn't dramatic. It's the disciplined application of provisions that have specific rules, documentation standards, and qualification criteria. If a strategy requires you to ignore documentation requirements, misrepresent personal expenses as business expenses, or pretend you're operating in a state where you don't live, it's not a strategy, it's a risk. Next week, we move into the most requested topic of the season, the S Corporation. What it actually is, a tax selection, not a business entity, how it changes the way your income is taxed, and the break-even math you need to do before you ever consider filing for one. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.